Chapter 6, we're going to kind of stay focused on merchandising businesses, but we're going to now kind of uh, double click on one particular aspect of what we were doing in chapter 5. And it's going to relate to how we do the accounting for inventory. Okay, so um, there are certain, and this is kind of review. We're going to talk about some of the accounting principles, and this is kind of just it does relate to what we're doing in this chapter, but I think it's just a good refresher on we I think we covered these in chapter 1, so just to remind you of some of the important accounting principles and like kind of what they mean. And again, the goal is that you're going to keep these principles in mind and see how they're playing into the different rules for the different kinds of accounting topics that we're going to cover. Okay, so we're going to talk about some of those principles. Um, this is kind of the main part of the chapter is these inventory costing methods. So what they are, why they're important, we're going to talk about that. Um, And related to that, we're going to see that depending on what method you choose, and again, this is an instance where you can have same transactions happening, but your choice of accounting method is going to change the financial statement. So we saw this in a couple things with like cash versus accrual basis. You have some choice in your accounting method, and based on that choice, and again, there's no right or wrong answer, uh, but based on that choice, you're going to change what your financial statements say. So we're going to talk about how the choice of this inventory costing method will change your financial statements. Um, we had the idea of shrinkage. What was shrinkage? Does anyone want to help me? You just did chapter 5, so hopefully you remember. It was a way of calculating or like taking a loss for theft, damage, errors. Um, we have kind of another instance of this where something goes wrong with your inventory, but this time it's not like it's lost or stolen. It's just it loses value, right? Like let's say you were, the Apple store and you bought a bunch of iPhone 4s back in the day, and you still have those in inventory. Do you think they're worth the same now as they were back whenever they first came out? No. So inventory oftentimes loses value. Okay, so we're going to talk about how to account for that. Um, this is kind of a minor topic. If there's an error in your inventory accounting, how that affects kind of your financial statements, and how it kind of self-corrects. We'll see that. And then so we talked about in a merchandising business, we had the gross margin was one lever that the business can pull for earning a profit, which is we saw the luxury retailer, right? Their gross margin was very high, meaning they buy for one price and they're able to sell whatever it is, clothes, furniture, for a much higher price than what they paid for it. What was the other lever that we talked about? Does anyone remember? You can either, yeah, turnover, right? In the example of the banana, you can either sell, if you buy the banana for $1, if you sell it for $5, that's a big gross margin. But maybe you're not going to sell that many because no one's going to pay $5 for a banana. So though you could sell one and make a big gross margin, maybe the better option is to price it for $1.50 and just sell way more of them. So even though you're making a much smaller margin, you're selling many more of them, and that turnover is gonna result in a higher profit. Okay, so we'll talk about the measure of how to calculate that inventory turnover. Okay, so that's kind of the other part of merchandising business.